Markets don't fear bad news. They fear what most people haven't noticed yet. Most investors are conditioned to react to outcomes. A headline appears, a price moves, and the assumption is immediate. Something just changed. But in reality, markets rarely move when outcomes are announced. They move earlier, when incentives, structure, and access begin to shift quietly beneath the surface. Financial systems don't upgrade overnight. They evolve through internal decisions, regulatory discussions, and infrastructure testing that never makes the front page. What most people misunderstand is this. Institutions don't chase narratives. They prepare for scenarios. By the time a new system feels obvious to the public, it has usually been modeled, stress-tested, and debated for years behind closed doors. Right now, much of the conversation is focused on bold claims, definitive conclusions, and where prices should go next. Those stories are loud, but they're rarely how real financial change begins. What matters more is what assumptions might no longer hold, what friction is being quietly reduced, and what frameworks institutions are preparing for before they are forced to act. This isn't about predicting a single outcome. It's about recognizing when the environment starts to change before the market fully acknowledges it. So instead of asking whether the next move is up or down, the better question is this. What might the market be adjusting to long before it becomes obvious? Over the most recent period, XRP experienced a noticeable increase in volatility compared to the prior weeks, following an extended phase of relatively narrow price movement. This shift occurred alongside uneven liquidity conditions across the broader digital asset market, rather than as part of a synchronized market-wide rally. From a factual perspective, several developments took place concurrently. First, regulatory engagement around digital assets continued across major jurisdictions. Ripple remained involved in policy discussions and consultations with regulators in the United States, the United Kingdom, and parts of Europe. This participation reflects an ongoing process rather than the announcement of any finalized regulatory decision. Second, activity on the XRP ledger progressed in areas that have been under development for several years. These include settlement-related applications, tokenization pilots, and the expansion of stablecoin usage on the network. These initiatives represent incremental implementation steps, not a sudden shift in direction or scope. Third, outside the United States, a number of jurisdictions continued limited pilot programs using distributed ledger technology for real-world assets. Some of these pilots advanced from initial testing into controlled secondary trading environments. While the overall scale remains modest, these projects are operational and regulated rather than conceptual. From a market data standpoint, trading volume increased relative to the previous low volatility period. Price movements became faster, indicating short-term repositioning by participants. No new U.S. legislation was passed during this time frame. No official announcement designated XRP or the XRP ledger as required financial infrastructure. Compared with the prior month, the primary change was the pace of activity, not the underlying structure. Regulatory frameworks remain in progress. Infrastructure initiatives continue to advance gradually. Market behavior reflects adjustment to evolving conditions rather than confirmation of a resolved outcome. At this stage, the available facts point to continued engagement and development, but not to final adoption, formal endorsement, or systemic integration. To understand why these developments matter, it's important to separate events from effects. Markets rarely react to a single data point. They respond to how multiple changes interact over time. At the surface level, nothing decisive has occurred. There has been no finalized legislation, no mandated institutional adoption, and no confirmed system-wide shift toward any single digital ledger. Viewed narrowly, that can make recent developments seem inconsequential. The relevance appears at the second-order level. When firms such as Ripple are consistently involved in regulatory dialogue across multiple jurisdictions, the immediate impact is not market price. The impact is optional planning. Institutions begin to evaluate whether certain technologies remain legally viable, scalable, and operationally reliable under a range of regulatory outcomes. That evaluation influences behavior well before public decisions are made. It affects internal budgets, technical integration timelines, and the scope of pilot programs. These steps are not visible to the public, but they shape future deployment pathways. Infrastructure development follows a similar pattern. Payment rails, settlement layers, and custody systems are not replaced quickly. They require extensive testing, regulatory alignment, and operational validation. Each successful pilot or controlled implementation reduces execution risk, even if it does not immediately lead to widespread use. The impact of this process is uneven. Retail participants tend to feel changes through price movement and volatility. Institutions feel changes through cost, reliability, and compliance constraints. If a ledger or asset can demonstrate consistent performance, predictable transaction costs, and compatibility with regulatory frameworks, it becomes a candidate for specific use cases. That candidacy does not guarantee adoption, but it alters long-term planning assumptions. Liquidity dynamics are another key factor. Large-scale transfers require sufficient depth to minimize slippage and operational risk. This consideration depends on market structure and settlement certainty, not on short-term speculation. What ultimately matters is whether friction within the system is being reduced. Lower friction changes incentives. Changed incentives influence behavior. Over time, behavior shifts are reflected in market structure. This does not imply inevitability or certainty. It implies a process of gradual evaluation. Understanding that process helps explain why markets can begin adjusting before outcomes are formally confirmed, and why price movement alone often provides an incomplete picture. Historical context is useful when it helps us understand process, not when it's used to forecast outcomes. The purpose here is to reduce emotional bias by recognizing how structural change has unfolded in the past, without assuming the future must repeat it. A relevant comparison can be found in earlier transitions of financial infrastructure, such as the move from manual to electronic settlement systems in the late 1990s and early 2000s. At that time, the debate was not about performance or returns. It was about reliability, compliance, and operational risk. Adoption did not occur through public announcements. It occurred through parallel systems, pilot programs, and extended testing phases that attracted little attention outside the industry. Another useful reference point is the period following the 2008 financial crisis. Regulatory pressure increased, transparency requirements expanded, and institutions were forced to reassess core systems. Markets did not immediately reprice assets tied to compliance or infrastructure. Years passed while rules were clarified, systems were redesigned, and new processes were validated. Only later did market behavior reflect those structural changes. Within digital assets, a more recent example is the evolution of stablecoins and institutional custody solutions between 2018 and 2021. Early implementations were limited in scale and scope. Regulatory clarity lagged technical development. Broader institutional participation emerged only after operational reliability and legal frameworks improved. Across these examples, a consistent pattern appears. Long periods of uncertainty preceded adoption. Technical validation came before broad usage. Regulatory alignment lagged implementation. Markets reacted unevenly and often prematurely. What did not precede outcomes was consensus or clarity. What is different in the current environment is the starting point. Distributed ledger technology is no longer experimental in principle. It already exists within financial workflows in multiple regions. The uncertainty today is not whether the technology works, but how and where it fits within existing regulatory and institutional frameworks. History does not tell us what will happen next. It helps us recognize that structural transitions are slow, incremental, and frequently misunderstood while they are underway. That perspective doesn't remove risk. It simply helps keep expectations grounded while change is still unfolding. At this point, the most disciplined way to frame the outlook is through probabilistic scenarios, not predictions. Markets respond to sequences of conditions, not single events. Each scenario below is built on if/then logic and reflects how institutional risk is typically assessed. Bull case, strength through reduced friction. If regulatory clarity in the United States improves incrementally through legislation, court rulings, or consistent agency guidance that reduces ambiguity, and if institutional pilot programs continue to progress from testing into limited production use, then the primary effect would likely be a reduction in regulatory risk premium. In this scenario, the driver is not excitement but permission. Institutions that previously avoided exposure due to compliance uncertainty begin to consider the asset operationally usable for specific functions. Liquidity improves gradually as participation broadens and volatility compresses rather than expands. Price appreciation, if it occurs, would likely be uneven and tied to positioning and liquidity depth, not speculation. This outcome does not require dominance or universal adoption, only sustained viability within defined use cases. Base case, consolidation with selective progress. If regulatory outcomes remain unresolved but constructive, and if infrastructure development continues at its current incremental pace, then the most likely path is range-bound consolidation. Under this scenario, development continues quietly. Pilot programs expand selectively, but large-scale commitments remain deferred. Market behavior is driven primarily by broader liquidity cycles rather than asset-specific catalysts. Volatility appears in bursts, followed by extended periods of inactivity. This reflects standard institutional behavior. Prepare extensively, commit cautiously. For participants, this environment tends to reward patience, position sizing, and risk control rather than aggressive timing. Bear case, prolonged uncertainty and opportunity cost. If regulatory clarity is delayed materially or shifts in a restrictive direction, or if alternative technologies gain clearer compliance or operational advantages, then the primary pressure would come from opportunity cost, not failure. In this scenario, institutions may choose simpler or more clearly sanctioned pathways, even if they are less efficient. Liquidity thins, speculative interest fades, and price becomes increasingly sensitive to broader market drawdowns. This outcome does not require negative headlines, only extended uncertainty that reduces the incentive to wait. Across all scenarios, one principle remains consistent. Outcomes are path-dependent. Small changes can compound, but they can also stall. No single development guarantees resolution. Professional risk management is not about choosing the most compelling story. It's about identifying which conditions matter and monitoring whether they are actually met. Rather than focusing on headlines or individual claims, I pay attention to indicators that reflect liquidity, constraints, and incentives. These tend to matter more over time than narratives. One of the first metrics I monitor is the US dollar index, DXY. Sustained dollar strength often tightens global financial conditions, which can weigh on risk assets broadly. Conversely, a persistent weakening trend can ease liquidity pressures. The level matters less than the direction and consistency of the move. I also watch Treasury yields, particularly in the intermediate part of the curve. Rising real yields increase the opportunity cost of holding higher risk or non-yielding assets. Stabilizing or declining yields often coincide with improved risk tolerance. While the relationship is not linear, it provides important context for capital allocation. Inflation data, such as CPI and PCE, remain relevant not for the headline figures alone, but for how they shape policy expectations. Markets tend to react more to changes in inflation trends than to isolated data points. Within the digital asset market, volume and liquidity are critical. Sustainable moves require participation. Short-term price spikes without corresponding volume often reflect repositioning rather than conviction. Open interest and positioning offer additional insight. Rapid increases in leverage can amplify moves in either direction and raise the probability of sharp reversals. When positioning becomes crowded, price behavior becomes fragile. Finally, I track regulatory signals over time. Draft legislation, agency guidance, and court decisions matter most when they show consistency. Isolated comments are less informative than a clear pattern of regulatory direction. None of these indicators provide certainty. Together, they help reduce surprise and improve risk awareness. This process isn't exciting, but it's how disciplined analysis is done. At this stage, the most important takeaway is not where the market might go, but how it is behaving under uncertainty. What we are observing is neither confirmation nor rejection of any single narrative. It is a market adjusting to evolving conditions while underlying structures continue to develop. Progress in financial infrastructure is rarely linear. It involves periods of experimentation, delay, and reassessment. That process can be frustrating, but it is normal, especially in systems that manage real capital at scale. There is a meaningful difference between possibility and probability. Maintaining that distinction helps reduce emotional decision-making and improves long-term outcomes. This isn't investment advice. It's simply how I'm reading the market right now. The focus remains on risk management, patience, and evidence. Over time, those principles matter far more than reacting to any individual headline. Markets tend to reward preparation, not urgency.